Okay. I'd like to thank everybody for joining the Team Florida's webinar on the financial market. From the perspective of COVID-19, we have a distinguished group of panelists ranging a wide variety and diverse background. Sharon will be moderating this presentation. Please keep in mind that we will be using the Q&A section for asking any questions to the panelists, so please operate that function. All attendees will be muted throughout the webinar. After this, we will be distributing a continuing education survey for anybody who wishes to fill that out and get their PE credits for the 1 hour of attending. With that, Sharon, I'll turn that over to you, sir.
Thank you, Brady. I hope you can all hear me well. And good afternoon, everybody, and welcome to this Zoom panel. So we have an excellent agenda here in front of us, and I'd like to begin by doing a quick round of introductions. We have Ann Ferrantino, who's a portfolio manager and senior investment analyst at Federated Hermes, a muni investor. Mike Lawrence, who's chief economist and president of Jack Fawcett and Associates, based in the DC area. Jim Calpin, a name you all know well, managing director and head of transportation at Bank of America. And last but not least, my colleague Scott Monroe from Fitch Ratings, who's a senior director. The first topic to cover is the economic picture. What do we expect to see over the next 6 to 12 months? Do note that we will have audience Q&A as part of this, so be prepared with your questions and email and send them into the Q&A tab as you think of them. So I'll begin with Mike, who's our economist, who will provide us some perspective and his insights into the current economic scenario and what we might expect to see in the next 6 to 12 months. Mike?
Thank you, Chernan, and hello to everyone. Great to be here today. I'm speaking to you today from my home in Bethesda, Maryland. And last time I was in my office, I was clean shaven. So I'm hoping I don't end up looking like Dave Letterman. You know, I'm just dying to get out of here and go back to the office, but who knows when that will be. We're all on hold, waiting to see what happens. So I was asked to talk a little bit this afternoon about recessions and where we are today and what we're seeing in terms of the economy and what kind of a recession this is and how long it will last, and some idea about what we should expect. Is this short, long duration, and how might it change us in the future? You know, all great questions. If you take me to the next slide, that would be great. Sure. Thank you. So, you know, economists are interesting sort of folks. We're not people who really are definitive about everything, although we think we know a lot. You can always talk to another economist and get another opinion. So feel free to ask all your economist friends if you're out on the golf course or whenever you get back to the golf course or out in the society in general, and you have that economist friend, you ask them, because you're probably going to get a different opinion than the last one you asked. Because uncertainty is what we live with, and we don't know really what the future is going to be like. And when folks tell you they're really certain of what it's going to be like, be suspicious, because they probably don't. Is this a bad recession we're looking at? We're looking at something we have never seen before. There's never been a recession quite like this. We think a little bit about what causes recessions, and usually it's a couple of things. One is the economy churns along over a period of time, and there's investment, and there's increases in productivity, and consumers are confident in their ability and their opportunity for spending their income. They're comfortable in the fact that they're going to have more income, and therefore they're willing to spend. And then over time, sometimes that confidence gets shattered by various kinds of things. And the economy may get to a point where we talk about it as being a little overheated. The demand or spending is high, and the economy is willing to slow down, but it often takes some kind of shock to make it slow down. So we've had in history a lot of different kinds of shocks that have slowed our economies. You know, so we've had energy crises, a number of those where the economy has been moving along quite well and then, you know, died on us. We've had the financial crisis that most of us remember very well just a decade or so ago. You know, in the 1960s, we were really rolling along. We had almost 10 years of growth, and economists, prominent economists, were writing papers about how we had really tamed the business cycle beast, that we had fiscal and monetary policy that allowed us to manage the economy, and business cycles might be a thing of the past, they were saying. And then all of a sudden, we had the Vietnam War, and we had excessive spending during the Vietnam War, and we had some loss in consumer confidence, and lo and behold, we had a recession in 1969, 1970. Not a severe one, but it made all those economists who wrote those papers start to say that, oh, what's going on here? We thought we had this figured out. And then, of course, we had the oil shocks in the 70s and 80s. And oh, boy, I guess we really haven't figured this thing out all that well after all. So in the 2007, 2008 financial crisis, we really got hit hard by something we hadn't seen before, and that was the mortgage-backed securities and the financial crisis that followed from that activity. And we didn't really know how to manage that all that well, but we knew we had to stimulate the economy. We used both fiscal and monetary policy to do that, and we had to spend a lot of money, and we had to make a lot of liquidity available to the marketplace. And now we have this recession, which is very different from anything we've ever had before, as I said. You know, economies churn along for a number of reasons. You know, populations grow, and therefore you have a bigger economy. We have gains in productivity, so we get more out of our labor, we get more out of our investments. Economies can grow and provide general well-being for the population, and things are moving along well, and then something happens that changes that. In this case, obviously, we decided we were not going to go to work anymore. We were not going to go to restaurants anymore. We were not going to go to sports events. All these things which we used to spend our money on, we were going to stop spending our money. And that's a shock to the economy, a shock like it's never really seen before. So economists have been sitting back and trying to understand what this means. Is it something that is going to come back quickly? Is it something that's going to take a long time to come back? How long does a recession last? Well, there's all different lengths for recessions, but on average, it's about 11, 12, 13 months, something like that. And the likelihood of there being a recession in any year is about 20%. So we have actually a downturn in the economy about every 5 years or so. But of course, the last 10 years, 12 more, I think back in last summer, we went over the months of continuous expansion record. So we had the longest continuous expansion, adding to that record each month as we came up to January, February, now March and April and May of this year, when things turned around very suddenly, and turned around not because of some underlying difficulty or challenge in the economy. It wasn't a lack of liquidity. It wasn't inflation. It wasn't deflation. It wasn't the things, or it wasn't oil crisis. It wasn't the things that usually throw us into a recession. It was a virus, and a virus that led us to say, how do we defeat this virus? We don't have a vaccine. We don't have treatments. We have to protect ourselves. We have to protect our medical system, our hospital systems. So we shut everything down. And we've been defeating the virus in places where we have done that and done that well. We hope we continue to do that. There's some obviously questions that we all have these days of what's going to happen over the next month or 2 months. Are we going to have these rebounds? And people give us plenty of warning about them. The answer is we just don't know at this point, and we don't know how it's going to affect the economy. Hopefully the economy can continue to come back, but I think it's, in my opinion, again, ask those other economists, but I think we're talking about 12 months of very difficult times. And in the long run, what's going to happen? I'm not entirely sure, but I think we're going to be challenged for a good while now. Can you go to the next slide? So consumer confidence is like one of the most important things when we deal with the economy. Consumers have to be willing to spend their money. This is the University of Michigan Consumer Confidence Index. And you can see it took a huge dip beginning of this year. We had a little bit of a rebound towards the end of it, and their predictions from the University of Michigan are that it will continue to drop for well into the summer, and hopefully start to come back late summer and fall. Now you can go to the next slide. So we're looking at how travel changes. What's going to happen to travel? And this is the Federal Highway Travel Monitoring Program. Give you some information about where traffic is changing. And you see traffic has dropped like crazy all over the country. I can say that in the Gulf South, that's actually the lowest reduction of all the reductions across the country. Go to the next slide. And here we have the VMT is estimated by the Federal Highway Administration month to month. And you can take this graph and you can send it back to the left, back 30, 40 years, and it looks just like what you see up here. But all of a sudden, boom, there is just no precedent for that drop in traffic. It is huge. It is very impactful. Whether we recover entirely from that and how long it takes, hard to say, but hold your horses. Hang on, because it's going to be difficult. And with that, I'll pass it back to the moderator and we can move on. Thank you.
Thank you, Mike. And we'll move on to Scott Monroe, who will provide us a perspective from a Fitch standpoint, as Fitch has an economics team that takes its view on baseline and downside risks. So Scott, if you could talk about that, and also our perspective on what a return to normalcy might look like.
Great. Thanks, Sharon, and it's a pleasure to be here. Sharon, could you flip to the next slide, please? I'll talk about Fitch's economic view over the next 12 months. So in terms of GDP, our economists project that GDP is going to decline by about 5.5% for all of 2019. Now, if you go though on a quarter-by-quarter basis, we think that the peak loss is going to be about 12.5% year over year. Now that'll just be in a single quarter though. So for the year, we're projecting it to decline 5.5%. And to put that into perspective, during the Great Recession, according to the St. Louis Fed, the peak to trough GDP decline was about 3.3%, and that was already what would constitute kind of an outlier for a severe type of scenario. So we as a firm are projecting that this crisis is going to be significantly worse than the last one. And that kind of flows through to these other economic metrics. So we're also projecting that unemployment is going to more than double, not quite triple, as compared to 2019 levels. And between employment and GDP is going to have obvious implications for traffic and revenues for toll roads. And then moving down to inflation, it had been running at a pretty good clip over these past 2 years, just north of 2%. We're projecting that that's going to fall to less than 1%, and that's going to have implications in terms of toll road operators that mechanistically link toll rate hikes to inflation. And even for those who don't, it is going to have an impact on just the economic rate making flexibility moving forward. So some not great news from an economic perspective. And in terms of how we kind of segue from the economic forecast into the traffic forecast, we have a baseline scenario for what traffic is going to look like this year, and then we have a downside scenario for what it's going to look like this year. And to give you a sense on the development of the baseline traffic loss assumption, we calibrated it to observe the losses in San Francisco and Seattle. And the idea behind doing that is that these are two major regions in the United States that were hit early by the virus, being gateway cities to China, and we're also hit quite hard. And we haven't made any regional distinctions. We're assuming that the losses experienced there would spread to other parts of the United States for the same reason that the virus spread quickly from China to Europe and to North America, that it knows no boundaries. And I think that the data that's come out subsequent to creating these projections has proven that to be a pretty accurate assumption. So anyway, the traffic loss assumption for this year is 60% for the second quarter, when we viewed as having peaked. And then we're assuming, just like our economic forecast, that there's going to be some kind of recovery going into 2021. It's not going to be a full recovery. We think we'll be back to about 95% of 2019 traffic levels, but we are projecting this going to get better as the quarters progress. Now, on a downside basis, we're projecting that traffic loss is going to peak at about 75% as opposed to 60 under our downside scenario. We're still assuming an interpolated recovery going into 2021, but instead of getting back to 95% of 2019 levels, we're assuming we're getting back to just 90% 2019 levels. So that's our forecast for the next 12 months. Now, in terms of what's our perspective on the likelihood of return to normalcy, and what's the trigger? That can be the development of vaccine. I guess I would start out my answer by saying that, to me, a feature of a normal economic cycle is that ultimately in the recovery stage, you're getting back to the economic trend line, ultimately, as previously envisioned. And so from that perspective, I am skeptical that we will be getting back to normal. And this was a feature, for instance, of the Great Recession, where there is this permanent downward shift in economic activity. And the development of a vaccine, it is going to help. It's going to give people confidence. Mike Lawrence was just talking about consumer confidence. And, people need to feel safe when they go out and eat at restaurants and shop at the mall, et cetera. But it's not a cure-all. And fundamentally, even if you developed a vaccine tomorrow and manufactured hundreds of millions of doses for each American and distributed it widely, there's still balance sheet issues that need to be resolved. So just over the last 2 months, we've seen various corporate bankruptcies. Hertz filed for bankruptcy last week, JCPenney, McClatchy, a major newspaper company, have all gone bankrupt. Even for companies that have not gone bankrupt, they're facing much reduced revenues in many cases, but still have to pay certain expenditures. And how they've been bridging that gap, well, what a lot of companies have been doing is they've been spending down their cash or taking on debt. And when you have a company or a household that has less cash or more debt, they are not going to spend and invest the same as they would if they had more cash or less debt. So I think that that's going to have to work its way through the system. Similar dynamic for households. And then when it comes to state and local governments, unlike the federal government, states and locals can't print money. And I happen to be in the state of California, and as a result of the COVID-19 crisis, there's a $54 billion deficit that opened up. That's 37% of California's total budget. The governor's announced widespread pay cuts to state employees of 10%. And this is on the heels of the state just having finished paying off the debt from the last recession. So yes, I do think that growth can return to normal. And maybe the vaccine is going to be the impetus for returning to a normal growth rate. But I think that growth is going to be off of a permanently lower baseline, similar to the Great Recession.
Thank you, Scott. That was interesting to hear. I'll just move on to Anne. Anne, as you know, is a municipal bond investor, and she's been through a number of different cycles over many decades. And so it'll be interesting to hear her perspective on what we are facing right now, and also more broadly on the municipal market, which is so important for the toll road sector.
Thank you. And thanks for having me on the panel. I'm happy to be here. I think back to when 2020 started and thinking about what factors we thought were going to drive market. It was trade wars and the election, which you don't even hear much about now. And the probability of recession just felt so low, less than, what Mike was saying, even 20%. But we did hear of this virus in China. Just little did we know that we were on the doorsteps of the great pandemic, which we're experiencing now, which, like we've heard, is rivaling and potentially trumping the Great Recession, which was just another awful time to be, sitting in the seat as a newly investor. But what's very different about 2020 is that we have seen just an abrupt halt to worldwide economic activity. And so the short-term impact of this is significant. And from a credit perspective, back in 2008, while I felt, similar feelings of concern and fear and uncertainty, I was looking at credits from the perspective of how will they perform in a recession? I was most concerned if there was deflation, how would these credits perform? What toll roads would be able to make it, how would they perform well in that environment? Today, that's not the case. I am looking at that on a longer term basis, but first I have to make sure that these credits can get through the short-term impact and looking at how directly they are impacted by COVID-19. So we have had the stay-in-place orders across a vast majority of states. And so in terms of the muni market, that's going to impact sectors and regions differently. And so you're looking at how the COVID-19 is directly impacting them, and then also how much liquidity does this entity have to make it through to when we do reopen. And we have gotten some federal support to help with that. The CARES Act was passed at the end of March, which has provided $150 billion to states. Hospitals have gotten $175 billion. We've seen higher ed get some funding. Airports got $10 billion. Toll roads, they didn't get any funding. And I think Scott's going to talk a little bit more about that. Most toll roads do have strong liquidity. We also then had the Fed step in, and they are offering liquidity through the municipal liquidity facility, where certain states, cities, larger counties can borrow from the Fed up to 20% of their revenues from last year, and they can borrow for up to 3 years. And these are new issue loans. So you would have the states or whoever is looking for liquidity from the Fed will have to borrow directly from the Fed. The Fed is not coming into our market and buying existing muni bonds like they are in other markets like corporates or mortgages. And so that has been helpful to our market in terms of providing at least a backstop, because a lot of our credits have been directly impacted. I mean, I'm sure the toll roads in Florida, traffic, Miami-Dade Express, they issued disclosure saying, that traffic was down over 50%. So if we look at the slide that I put up, what I just wanted to show you was a perspective of how has the muni market performed through this? And it is vastly different from region to region and within each sector. So now this is as of April year to date, and the muni market April year to date has, and year to date today is underperforming other fixed income asset classes like investment grade corporates, mortgages, treasuries. And it's not that corporate bonds aren't going to default. I mean, we just heard of a couple that have, but it's that I think there's been a lot of negative press on munis in this go around. You have, talk of potential state bankruptcies, which, is not possible by the Constitution, but we've seen scathing articles in Barron's and Forbes, just talking about how dire this is for munis. So if you look, and just to see, we were down 175 as of April year to date. Munis are actually up now 68 basis points as of today. But if you look, the two sectors that were hardest hit are healthcare, with hospitals having to stop elective surgeries to create capacity for potential COVID cases, and they're looking at significant revenue losses from this. And then also the life care, that's a sector that has been directly hit. Now they make up a small portion. This is the S&P main muni bond index. They make up a small portion of that index, but they make up a much bigger portion of the muni high yield index. So they are down over 13%, because even in Pennsylvania, which is where I am in Pittsburgh, over 60% of our deaths from COVID-19 did occur in nursing homes. But then transportation is the other sector directly hit. And of this, you can see, I have a question. Okay. As you can see, the toll roads are actually outperforming on a relative basis, but you see airports are down over 3%. The other transportation, that's the transit authorities primarily, down over 6%. So the sectors are being impacted differently here. Now on the next slide, when I'm looking to buy a bond, I am going to look at the price of that bond relative to, or the yield on that bond relative to where I could go out and buy a AAA rated GO bond, which is the MMD AAA scale. So what this slide is showing you is if I want to go out and buy a toll road, let's say I can go and buy a AAA rated state for the 20-year bond for 144 yield. How much more am I going to get in yield by buying an A-rated toll road, for example? And if you look here, this is just showing the spread between where I'm going to buy a AAA rated bond and a toll road. Okay, and the green is AA rated toll roads, the red is A rated, and the blue is BBB. So you can see that spreads have widened significantly as expected given COVID-19. So I can easily go out and find an A-rated toll road right now that's going to be over 100 basis points to the MMD, which prior to this, and if I could get 50, I'd be lucky. But if you look back historically to where we were in 2008 and 2009, the spreads of 100 are still lower than they were back at that time. And I think the reason for that is because toll roads are starting off from a position of strength. Through this recovery, this prolonged recovery that's lasted over 10 years, toll roads have built up their balance sheets, they have strong liquidity, they have done a lot of their capital projects that they needed to do. They have implemented automated tolls, and they have automatic toll increases a lot of times. So while spreads have widened out, it's still not as bad as it was back in the 08-09 crisis. But I do think potentially, you could find opportunity here for those that, like I said, have the liquidity to bridge the gap between now and any recovery we see.
Thank you, Anne. So moving to the next slide. Okay, so you've heard that the situation is somewhat dire, yet there's a silver lining, particularly in the toll road sector. And I'll hand it over to Jim to talk a little bit about it from the perspective of an issuer and also where the market is for issuers.
Sure, thanks, Sharon. Appreciate being here. Yeah, I want to sprinkle in, I guess, some good news, because we've been out it for about 25 minutes, and it does sound dire. But from a market perspective and a toll road issuer perspective, we're functioning. We haven't normalized by any stretch. You saw Anne's charts in terms of the spiking in terms of credit spreads. But I think you have to put that in relative value to where we are with absolute interest rates. We're still in an incredibly low interest rate environment, and will likely be there for some time, especially as you listen to various economists forecasting a very slow and potentially painful recovery. So I don't think we're going to see any inflationary data for quite some time. The good news from our side was that the frozen days and weeks in March, we did thaw pretty quickly. A lot of that was driven by the Fed in terms of injecting quickly a lot of liquidity into the market. They faster than they did in 2008. They learned various lessons from the last recession. So they came in a very big way, which stabilized the front end of the market, which then led to the opening or stabilizing of the long end of the market. So we've seen yields rally back quite a bit over the last few weeks, and that's driven a lot by the reversal of money market outflows. I mean, we saw a record amount of outflows as every investor just sold everything they had, whether that was equities or munis, and it didn't matter which munis. They were just selling gold, oil, just to get to a cash position. So that forced selling just drove prices down and yields higher in a very, very dramatic way. So we rallied back from there. Better credits are obviously doing better in our market. But to Anne's point, most toll roads, especially the established ones, are in the A category or AA. And all of the rating agencies, while moving to a negative view or negative outlook on the transportation and toll road market going forward, we haven't seen any draconian downgrades across the board in terms of the transportation space. Maybe a real life example of a deal getting done and just showing how our market is functioning in the toll road space is the Triborough Bridge Tunnel Authority here in New York City, which was devastated in terms of the traffic and revenue decline. Yet they readied and went to market last Thursday with a $400 million AA rated toll revenue credit. To Anne's point, the credit story is what investors want to hear. What's happened with COVID-19? How are they reacting? What changes are they making? What kind of coverage do they have? What kind of liquidity do they have? And in most cases, there's ample liquidity and coverage to weather this near-term storm. One interesting thing is we got 18 different requests for one-on-one calls from investors, and a vast majority of those requesting those one-on-ones came in with very meaningful orders. So the deal, as I said, sold Thursday, 400 million, and received over $5 billion of orders in our market. So we were able to lower yields by up to 10 basis points. And there was so much demand, the authority decided to upsize the transaction to over 500 million. So taking advantage here of a very strong market. So, you know, as I said, we haven't necessarily normalized because if you look at the spread on the TBTA deal, it's probably about 50 basis points wider than where they would typically come, which sounds like the bad news, but the good news is when you scale that against where our MMD index is, they borrowed 30, 35-year money out at around 2.5%. So it's a very good time, you know, in terms of being in the market. You have agencies who are trying to preserve cash. It's a great time to come back to the market. It's really about the COVID-19 disclosure. It's taking it's preparing and offering a little more time in the pre-marketing and marketing to get on the phone, as I said, with investors in these one-on-ones. Where in the past maybe they'd looked at a credit and, you know, they had already had it pre-approved. Here they really want to dig in on what's COVID-19 done to this agency and what's their outlook. So I'll leave it there.
Great. Thank you, Jim. You know, as you mentioned, particularly what we see credits globally at Fitch, and what we've tended to see is the U.S. municipal credits, particularly the transportation and other kind of systems in the public systems in the U.S., have tended to maintain a lot more flexibility, and as a result, they've had more latitude to deal with crises, not just now but also in the past. And Scott will talk about that in a minute. What I will do at this point, we have one question, and the question that we have is about how, in fact, infrastructure investment can be dealt with, you know, given the environment we're in and also the political situation we're in. But what I'm going to do, if you don't mind, for the person who asked that question, is we'll hold off on that to a discussion that I think Jim's going to get to a little later on what may be happening to Washington. Hopefully we'll have enough time for all of that. So I'm going to switch at this point and move on to the financial credit picture, where Scott will get an opportunity to talk a little bit about how we're seeing things in the near term in the toll road space.
Sure. And kind of to the point that Jim and Ann were making, from a liquidity perspective, toll roads, generally speaking, are in a very strong position. In fact, it was one of the main factors in there not being kind of widespread downgrades or negative credit action. So we took all 60 rated toll roads back to committee in light of COVID-19, and that's publicly rated and privately rated. And only about 20% had some form of negative action taken, and the vast majority of those were rating outlook negatives as opposed to outright downgrades. And what was really supporting toll roads was their strong liquidity positions. And consider that the obstacles that toll roads are up against right now. So for passenger vehicles, traffic is generally down about 50 to 60%. On managed lanes, it's even higher. Typical loss rates are running at 60 to 70%, and the trucks are down about 10 to 15%. Now, what is really helping out toll roads, though, is the kind of the nature of the crisis being time limited. In conjunction with these strong liquidity positions. So the majority of toll roads have debt service reserve accounts sized to about a year. On top of that, they tend to hold on to pretty solid unrestricted cash balances. And then many, if not most, toll roads were heading into the crisis with already healthy debt service coverage ratios. So I would say that most toll roads aren't dipping below 1x on debt service coverage ratio basis this year. And to the extent that a minority are, it tends to be, you know, we're projecting a relatively small draw that ought to be replenished next year once there's some sort of recovery in traffic. And as you switch from standard toll roads over to managed lanes, on top of the liquidity I already noted, They also benefit from some additional debt structure provisions like the deferrable TIFIA debt structures that you frequently see with managed lanes, where if you can't pay off scheduled debt service, then a portion can be deferred to later years. Also, some of them have ramp-up reserve accounts that are still in place and other debt structure features that are helping to get them through the crisis. But kind of switching gears to how can toll roads manage their businesses proactively, meet their debt service obligations, and maintain their rating levels. I think the advice that I would give to toll road operators is that there is so much focus right now on what's outside of your control with the virus and the stay-at-home orders and the traffic losses, that really the focus needs to be on what is in your control. And there's a few levers that can be pulled at this point. One of those is rate hikes, and understanding that it is impractical to raise rates during a crisis like this, if not politically impossible. But once the worst of the crisis has passed, policymakers will have an opportunity to raise rates, as they had done during the Great Recession. And I think that the evidence from the Great Recession is that made a big difference. If you look at the difference between how much traffic declined and how much revenue declined, which was significantly less because of how many facilities were raising their rates. On the cost side, variable costs, of course, are going to fall automatically, but particularly on the toll collection side. But other operators are finding opportunities to cut fixed costs as well. Then on the capital side, capital improvement plans are likely going to need to be revisited, and a lot of projects may need to be deferred, scaled back, and to the extent that capital plans were being driven by growth-related needs, those might need to be reconsidered as well. What's interesting is we're starting to see a subset of some of the stronger toll road operators actually accelerate their capital plans, and they're taking advantage of the current environment to speed along construction in a way that might not have been possible before the crisis hit. So a little silver lining there. And then finally, the last point I would hit on is just the ability, if none of those options are available, for some form of debt restructuring, to the extent that a toll road operator could push back near-term debt, provide them with that near-term flexibility that might be needed on a one-time basis, and really take advantage of the underlying strength of these core and long-lived toll road assets.
Thank you, Scott. So that's interesting. So now I'm going to switch back to the panel, and given that we have about 15 minutes left or 20 minutes left, I want to make this a little quicker in terms of time, just so that we can get through all the questions that we have. So we'd like to talk now about the trajectory of recovery, and begin with Mike, and then we'll get to some of the other panels on the same topic. So Mike, whatever you can add in a couple of minutes would be great.
Sure. Thank you, Chairman. And hello again. So lengths of recoveries are an issue that economists spend their careers, some of them, studying, focused on what makes recoveries slow or what stretches them out. One of the things that economists are trying to understand, which was really different about the past decade, is that we had a very slow recovery. We didn't spike up very quickly. We stayed relatively steady at the 1 to 2.5% growth rate up to today. And I know it's one of the questions someone was asking about, well, when are we going to get back to 4%? Well, we haven't gotten to 4% in an awfully long time. And we found that the steady growth of, say, 1 to 3% seemed to work well for the economy, that we had a lot of optimism within the economy. People were confident that they could consume and move forward. And we began to think a little bit about those economists in the 1960s that thought maybe we've controlled this business cycle thing, that maybe this long-term 2% growth was what we really needed. We didn't want those 4 or 5 or 6% boosts that we had to take a deep breath afterwards and then have a downturn and recovery from. Maybe we could maintain this 2-3% growth for a long period of time, not have recessions, and not have sharp downturns and upticks where individuals were harmed by loss of employment or by liquidity problems within the system as a whole, so that steady, lower growth might be what we really need to manage the economy. Of course, we don't know how long we would have gone in the current circumstance without the coronavirus hitting us and having our decision to shut down the economy. Would we still be moving along at 2 or 3%? Maybe. It may have gone a long time, but people began to talk more and more recently, of course, looking at the length of previous recoveries and saying, "Oh, look at this. We just hit a new record, and every month we hit another record." So speculation was growing more and more that maybe we're going to see some downturns. There was a lot of discussion last year about the yield curve, for example, inverting, and whether that was a sign that, ooh, we're at the end of this thing. And then we sort of kept moving on after that. We seemed to get over the worry about the yield curve. So there's a lot of uncertainty about where we are and where we're going to be in the next turn of events. I think a lot of what Scott said is very accurate in terms of what the future can look like and how we can grow and how we can recover from this current downturn. But I think caution is a word to the wise right now for a while. I'll turn it back.
Thank you, Mike. And we'll move on now to the rest of the panel. Starting with Anne. Anne, as a buyer of debt, you have to think very long and hard about these investments. So could you talk about how you would react in such an in the environment we're in?
So with the implications of COVID-19, social distancing, and the economic halt in activity, pretty much every muni credit has been impacted by this. However, I think what's been forgotten is that munis are truly a high quality, viable asset class. And as Jim was saying, when this started in March, people were just selling munis regardless at any price. And this really created, I felt, an opportunity to buy these high quality AAA, AA munis. So while there may be downgrades to these credits, the default and distress are not going to come in AAA, AA munis. So since the crisis has began, I have been buying those types of credits and getting good value in those purchases. Now those credits are starting to recover, and I do feel like there are opportunities in even those sectors that have been hardest hit, like toll roads. It's just a matter of finding what toll road you want to buy, preferably one who doesn't need growth to service their debt, one who doesn't, that has, strong liquidity. So I am looking at potential opportunities in those harder hit sectors now.
Thank you, Anne. And Jim, you talked a little bit about some of the opportunities that there are for issuers. Could you talk a little bit about how best to deal with the fact that the length of this recovery is unknown? It's not like anything else we've seen. So how does an issuer best deal with that in this circumstance?
Sure, and I think everyone's looking to the the rating agencies and how they are stressing their credits in these downside scenarios. And I think it's being able to thread the eye of the needle of the worst couple of years that are ahead here in terms of a slow recovery. And we hope, knock on wood, in terms of any sort of secondary effect, but we hopefully have bottomed. And we're obviously seeing a few data points in April and May across the different whole agencies that are giving us encouragement that we're at least starting on the road back. Sorry, no pun intended. So it clearly, in our mind, is the near term. It's the next, we'll call it 3 to 5 years. And regardless of most agencies having strong coverage, they can protect themselves by as simply as deferring principal for the first few years, deferring principal for the next 5 years where it's just interest only. They could use a variety of lower coupon bonds as well. They're becoming a little more in vogue with investors, despite some price implications, but that can also be used. I think, as I said before, it's a great time to be in the market. It's a great time to be in the long end of the market. So It's not just necessarily selling a long bullet, but it's taking a look at an issuer's overall debt portfolio and where debt can be smoothed, maybe in the middle to longer part of their outstanding portfolio. You have issuers who are, we said, preserving cash and instead going to the bond market. If they're sitting on cash in short-term investments, they might want to consider a small portion of their portfolio in a floating rate, variable rate product as an asset liability match. It does come with some risk. It's not then long-term fixed rate debt, but it's a way to maximize some of their cash. What we aren't seeing is restructurings. You know, no one's in a dire situation where they're, quote, scooping and chucking the front end and deferring debt out longer. I think it's, again, to the credit of these assets that have done quite well and are built to really withstand a downturn. Others are using some of their cash and defeasing the next principal or two, and just by doing so, improving coverage. You know, they're obviously using some cash, but some of them are sitting on substantial cash. So that would, it's a quasi-refunding by using your cash and just giving them a little more runway in terms of the recovery. So others are looking at the TIFIA program. It's a long, involved process. We get that, but you can borrow 30-year money from the government if you can get the loan right now at a 143, you know, which is pretty good in terms of 1.43% cost of capital. It can be a longer process. You've had IBTTA as an agency write to Congress, and they're looking for over $9.5 billion in direct assistance, which is one ask. The other is asking the government to tweak various programs to allow the toll agencies to help themselves. Some of them are geared around changes to the TIFIA program, which would involve, you know, can I change the rules, if you will, that I can come in and refund my old TIFIA rate down to a lower rate. It comes with a lot of different implications, but it's the kind of the smaller things rather than just the giant ask in terms of absolute cash injection. So I think, you know, again, issuers aren't doing things dramatically different right now. I think they're just being a little more cautious in their structures, but nothing where they're having to do a taxable refunding which could prove costly to buy themselves some debt service coverage. And then for any of the current refundings that are in the money, I think you're seeing a lot of agencies shaping the refunding savings to be over the next few years if possible. And again, just providing a little more cushion or a buffer.
Thank you, Jim. And Scott, Jim mentioned the rating agencies and how we look at things at, you know, in your case at Fitch. Could you talk a little bit about that and how we're looking at long-term credit risk in this environment?
Sure. You know, how we're looking at credit through the long term is really informed by the great amount of uncertainty that we're now facing. As Michael had said, we haven't been through a scenario quite like this before, and so there's an atypical degree about what is the future going to hold after the immediate crisis is passed. And because of that, you know, generally we would have two cash flow projections, two sets of cash flow projections, one called the base case, and another is kind of conservative downside scenario called a rating case. Because of the great degree of uncertainty here, we've added two additional ones. The coronavirus sensitivity case is what we call one of them. What that does is says, well, what if this crisis is more severe than we think it will be, and there's a greater immediate impact. And then we also have a fourth case, it's called the coronavirus severe sensitivity case. And that asks the question, what if the duration of the crisis is longer than we think it will be, and we're not back to 2019 traffic levels until 2024. So we have run all of these cases against our entire portfolio, and we've kind of, in a way, we've sort of bifurcated the analysis. So for 2020, we're really focusing on liquidity. Is there the cash to get through the very worst? And then when we presume that there's going to be some degree of recovery in 2021 and onward, that's where we're really focusing more on that long-term piece of it that this question was about. And what we found is that in about 4 out of 5 cases, under the assumptions that you see here, under the 3 cases, that generally credits are kind of sticking within the band of financial performance under which they had been rated based on their current ratings. So we affirm those with a stable outlook. But in about 1 out of 5 cases, there was financial there's material financial impairment. And in those cases, we generally put them on a rating outlook negative. There was one exception where we downgraded one toll road facility, but the vast majority where there is some kind of negative action applied, we're rating outlook negatives. And it acknowledges two things. One is if the crisis pans out in the way that we are now projecting, there's going to be financial impairment on the one hand, but on the other hand, it also acknowledges that toll road operators have certain levers that they can pull, some of which I had outlined before. And our typical negative outlook window, we usually try to resolve within about 2 years. So what it acknowledges is over the next 2 years, assuming that the economy turns out the way that we're now projecting, that we're giving toll roads that opportunity, to raise rates or to find other ways to stabilize their long-term financial performance before we take a downgrade type of action.
Get to some of the questions that have been asked. So I'm going to just read out the questions. We did discuss the issue of 4% growth, so I'll skip that for the moment, but then just go to the other one that says, to the extent that toll entities seem to be retaining their financial positions, by comparison, how are the states themselves doing in terms of ratings as a counterpart provider of free roads? This is, I'll hand it over to Scott, who may have an opinion, but just for the record, both Scott and I have more of an infrastructure background, so we may not be able to provide you the kind of details that's needed here. But Scott, do you have a thought on this question?
Unfortunately, I'm not too sure about the specific rating actions taken against states. I know that in some circumstances, some state ratings have been downgraded. Some of those have been things like pension related or to budget gaps opening up. I do think that toll roads are in a better position to bounce back quickly to the extent that there's an economic recovery than states would be. When states were downgraded during the Great Recession, the ratings stayed at lower levels for a longer period of time, and in some cases it took many years for them to transition back up to where they had been. But my expectation would be that toll roads would bounce back faster.
And do you have a view on this?
I agree. So states, they have been provided support through the CARES Act, which is significant. At this point, it is only available to cover COVID-related expenses. We're hoping that there's going to be additional legislation passed, and the House has come up with the HEROES Act that is looking to provide more, up to $950 billion for states and locals, which should help them. I really think that they're going to need this support to make up for the tax losses and the job losses that they're experiencing, which is going to impact their credit quality. Whereas the toll roads, I think once you start to see a recovery and we start to get back to a more normal, you're going to naturally see these toll roads recover. And like we've talked about, they have time to get to that point. A lot of them have high debt service coverage. So even if you have a decline, say for a while, that's not the dire 50% that we're seeing, but maybe 25, 30%, they can still withstand that. And I think once investors get comfortable that we're not going to have, another stay-at-home order put in place because we see the virus return, I think investors are going to get very comfortable with the likes of a toll road investment or revenue bond that, that has strong credit fundamentals.
Just to jump in on this topic, it would seem to me that, the part of the question is about, will there be money for infrastructure? And I think particularly the free infrastructure that people don't pay for, versus toll roads. And it would seem to me that, yes, there will be additional challenges in terms of states, particularly finding the money to be able to fund infrastructure when in fact some of that funding has already been, stretched in many ways. What will be interesting, though, is whether there'll be some kind of an infrastructure investment program, particularly at the national level. And this goes to a question that was asked a little while ago that I'll just turn towards Jim for, and that is, how do you sell an infrastructure investment program, in this case, without politicizing it, which is the environment we're unfortunately in?
If I knew that answer, I'd be king. I think the notion of the infrastructure program, well, I'm just skeptical around all of this because I think we're running out of runway ahead of the election. The momentum of the infrastructure discussion that really ramped itself up at the front end of this crisis seems to have waned. The focus is turning back towards how do we get more money in the pockets of small mom and pops who were devastated, the restaurants, and not so much the toll roads that, yes, they all have losses, but they're all functioning, again, strong debt service coverage and liquidity. So the $9 billion ask from IBTTA, maybe that can go somewhere else. You know, I'm running the risk of IBTTA calling me after this webinar, but I think you need to see an immediate impact. And also non-diversion. You know, it can't be, let's do an infrastructure program that delivers jobs 2 and 3 years from now. And it's different than, 60, 70 years ago, where you had a giant unskilled labor force that could be put to work. We saw some of the stimulus money go into transportation during the last crisis. Some of it worked, a lot of it didn't. But you're right, in terms of the states and the non-toll road sector and the free assets, they saw a devastating blow to gas tax revenues, and that's real. And you're seeing DOTs having to scale back and slow down their capital plan. So any stimulus that can keep that moving, I mean, we're hearing that from a lot of DOTs. It's not so much they need a new program tomorrow, it's they want to keep these programs moving forward and their capital plans that they don't have to adjust in a very draconian way.
Thank you, Jim. Brady, we are at the hour. So at this point, I was thinking, unless you feel we have a couple of minutes, we should wrap up. I wanted to thank Anne, Mike, Jim, and Scott for an excellent discussion. And thank you, the audience, for joining us. We'll be happy to try and answer these other questions that haven't been answered or topics that haven't been addressed in some other forum.